So what do all of these economic cross-currents mean for the stock market and your investments? Joining us right now is Scott Wren. He's Senior Equity Strategist at Wells Fargo Advisors. Good to see you again, Scott.
Hi, Bill.
On a day where we saw really pretty poor retail sales figures for June, the stock market continued higher. Why the disconnect right now, do you think?
Bill, I think right now for some of this data, what's bad is good. And what I mean by that is bad economic data means the Fed is less likely to taper, which I don't really think they're going to do anyway until 2014 probably. But that's the way the market's reading some of these indicators right now. Bad economic news is good because the Fed's not going to make too many moves, at least soon, to reduce the amount of QE they're doing every month.
You know, what's not surprising is that we're having slow growth. We've known that all along. I think that, but the concern is like how slow is this growth going to be? And in some cases, what if it is negative? It goes to zero growth. Would that derail this stock rally that we've been seeing?
Well, Susie, certainly based on our projections, if we saw negative GDP growth, our target would be in question. Our earnings growth would be in question. So, I mean, we're expecting modest. I've used that word a zillion times over the last year, 5 to 6% earnings growth. We had been looking really for about 2.5% GDP growth this year. That may sound a little optimistic right now, though, but I think the market has priced in this slow growth. As I said before, I think the market right now is taking it as a positive that the Fed's going to be in here, because let's admit what's going on here. I mean, much of this rally, much of this move we've seen over the last few years has been due to the Fed's easy money policies and all these central banks around the world. So that's what the market wants. I think we're going to continue to see very easy monetary policy out of the Fed for a long, long time.
Lately, Scott, if you think the economy is going to grow, you buy cyclical stocks. If you're worried about the economy, you buy defensive stocks. Here you are talking about maybe being a little too optimistic about the economy and its growth rate, but yet you're still going with the cyclical stocks. Why?
I think so, Bill, because in my opinion, we're going to see a continuation, despite what we saw out of China here, a little bit disappointing numbers. I don't think they'll get much lower than this, but I think the global recovery is going to continue at a modest pace. I think our recovery is going to continue at a modest pace, and I think you want to be in those sectors that are going to benefit, things like the consumer discretionary sector, which has done all along really this entire recovery. Technology, which has been up and down, I think that'll do better if I look forward for a year, and also I think industrials are looking better as well. Now saying that, if you looked at the sectors that performed last week when we had a great move up in the market, I mean, the S&P moved up 3%.
Right.
You know, it was the defensive sectors that led. I don't think that's going to be the pattern going forward, but certainly last week you see anomalies like that. So the market's in a state of flux here. I don't think we're going to go much higher this year, but I do think over the course of the next 18 months, the upside looks good.
Scott Wren, Senior Equity Strategist at Wells Fargo's Advisors. Good to see you again. Thank you for joining us.